Whatever your job is, you probably have a simple way to explain what you do, or maybe you have something like an elevator pitch. For example, I'm a stock and options trader. What does that mean? Well, I believe the example of how to earn 2% per month trading Apple is the perfect example to go over. So I'm going to do a deep dive today over a conversation that happened between a friend and myself over dinner, where I just realized if I just explained this simple concept about how to earn 2% per month trading Apple, he would realize that a sea of opportunity would open up without a ton of effort. So check it out. Let's take a look at the agenda for today. First thing on the agenda today is options in a nutshell. So if it's your first time learning about options, hopefully I can break it down as simply as possible, and then you'll be able to understand the concept going forward. The next thing we're going to do is I'm going to give a little bit of a story about how this exact strategy came up in conversation with one of my friends. Then I'm going to show you how I backtested this theory on eDeltaPro.com and how I was able to really gain confidence in whether or not this would work. Then we're going to talk about the results of the strategy, how it performed over the past 5 years. At the very end, we're going to look at the expectation versus reality. So what were my expectations going into testing the strategy? What were the results and how do they compare and how do I feel about them? So I want to take a minute just explaining options in a nutshell. So most people understand the concept that you can buy and sell a stock. Most people understand that you can sell rights to something, right? Like you can sell the rights to music. Disney has rights to all of their TV shows. People understand that you can buy and sell something at a certain price. People understand that you can buy and sell the rights to something. An option is basically the bridge between the two. So when you buy a call, you're buying the rights to a stock at a certain price. When you sell a call, you're selling the rights to a stock at a certain price. Now, another way to think about it, especially when it comes to a covered call, which I'm going over today, is you're renting out your shares. So in this case, I have 100 shares of Apple. Now, I don't really care if Apple goes up or down in value. I just care about receiving that rental income. Someone else has rights to my Apple shares if it performs a certain way, for example. So in this case, if Apple goes up too much, the person that bought the rights will be very happy that they have ownership in something that is more valuable than what it was when they bought the rights. For example, a house may fluctuate in value. You can rent out a house and receive rental income every month. Meanwhile, the value of the house can fluctuate up and down depending on interest rates, depending on what's going on in the economy. But you can still rent out the house and receive that income from literally selling the rights to the home, selling the rights for someone to live in it, enjoy it, and do whatever it is that you do when you rent out a home. It's the same thing with stocks. It's the same thing with a covered call. You can have 100 shares of a stock and rent out the rights to that stock. I hope that helps. And just think about that when we're going through this example. With a covered call, you're just renting out your rights to the stock. All right, I just want to give a quick story about how this strategy actually came up in real life. So I was out to dinner with a friend that I hadn't seen in a few years, and he heard that I was trading options for a full-time income. And he started asking me about it, and basically he said, I love my job, I don't want to think about anything else, but what is the easiest way to do your strategy or something similar, right? And I thought for a second, well, I don't want him to worry about technical analysis. I don't want him to worry about fundamentals or Fed announcements or anything like that. So I figured, what is the easiest way for me to recommend to him, but also additional friends and family, to make a consistent income on the stock market? So what I came up with on the spot, we were all sitting there with our iPhones in our hands, and I said, if you just sold a monthly option at the market price on Apple, you'll probably make at least 2% per month. And this was just top of mind from intuition from being a trader, but I didn't know for sure at the time whether or not it would play out. His response was, "That sounds great. I don't have to learn about any jargon about credit spreads or volatility." And I said, "No, just try it out. You'll probably make a consistent income." And he said, 24% a year sounds great. It's far better than what I'm doing now, and I look forward to trying it out. So I went home that night thinking, maybe it's not that easy. I don't have any data to back up my recommendation. I didn't want to mislead my friend. So the first thing I did when I got home was I went to eDeltaPro.com to see if this strategy would have worked. Now I'm going to do a back test of this Apple strategy. So first thing I'm going to do is I'm going to log in to eDeltaPro.com. Let's just make this full screen here. All right, back test. Let's start a new one. We want to look at Apple. Let's do it based off of Delta. Let's go 50. A 50 Delta is right at the money. I want to focus on calls. So we actually want to sell a call, excuse me. Let me delete all this. So we're going to sell a call at a 50 Delta, which is basically the same thing as at the money, which is basically wherever the stock is trading at when we open the position. We're also going to buy 100 shares of the stock. Let's do 30 days until expiration. I have sequential listed right now. So we're going to trade when the prior expires or closes. So we're only going to have one trade open at a time. No technical filters, no profit taking early, no exiting early, and no stop loss. So basically, like I said to my friend, we're just going to see how selling the call at the money on Apple performs with mostly, basically the least amount of thought or maintenance. This is for someone that's busy, that has a full-time job that they really enjoy. They don't want to put a whole lot of thought into the stock market, but they just understand that they can make a consistent income from selling options. So this is how this person is going to go about doing it. All right, so we have 1 year. Actually, no, I don't want to do 1 year. I want to do 2020. So December 31st, 2019, the last day of 2019 until the last day of 2020. We're just going to see how this goes. Okay. So for 2020, on the right, we have a little snapshot of some of the statistics, and I just scrolled down to show more detail. This is a 39% return on capital. So we beat the 2% per month in this instance. Over the past, in the year 2020, we beat the 2% a month expectation. Now let's go back and check out 2019. Okay, 2019, 55% return on capital. Again, anything over 24% per year would beat the 2% per month expectation. So this is a 55% return on capital. And that's looking at 11 trades. Actually, excuse me, that's looking at 12 trades. So I'm going to do this for each year, and then I'm going to put them together and show you the results. If you look at this trade over 5 years, it tells you kind of what it would look like if you decided to trade it yourself, right? Like if you have a certain amount of capital that you want to allocate to this strategy and you're only able to open one trade at a time, you would do it once a month, sell another call on your 100 shares of Apple. This time, So you can see trade by trade what that would look like. You can look at the trade log, see how much you paid to get in. So this entry premium is basically the cost of 100 shares minus the call premium that you received. And the exit premium is basically the money you got back when you got out of the position. So here you bought to close the call and then sold the shares. So we want to make this number as reliable as possible. We want to see if the strategy plays out over and over and over as many occurrences as possible. So what I'm going to do is I'm just going to go through 1 year at a time and see how this would have performed if we opened a trade every single day. I'm going to edit this. Instead of sequential, I'm going to make it daily. So right now we're just looking at the year 2020. We're opening a trade every single day. This gives more integrity to the data because there are more occurrences. The return on capital over a year was 22%. So if you opened a trade every single day, that gives us 236 occurrences. So 22% over a year, that's pretty close to my expected 2% a month. As you can see, I went ahead and did several back tests. And then I recorded the results in this spreadsheet. So I went through this twice. I wanted to see what the result would be or what the back test would show us if we just opened one trade per month. And I also wanted to see if this trade was opened on a daily basis. On the left, in column B, we have what's more reflective of how someone would actually trade this strategy, because you're probably only going to buy 100 shares of Apple at a time and sell one call on it, or one covered call of Apple at a time per month. That's realistic. But for the integrity of the data, we wanted to simulate this trade as many times as possible. So in column B, we have 13 occurrences per year, 65 occurrences in total. Column C, we have 236 occurrences per year and 1,180 occurrences in total. What you can see on the left, on average, the annual return was 25.2%, which comes out to just over 2% per month. This was very close. This actually exceeded my expectation of making 2% per month. When we looked at more occurrences, we found that the average annual return was 16.2%, and the average monthly return was 1.35%. Obviously, this is a little bit less than the expectation that I had going in, but the reality should leave us somewhere in the middle between this 2.1 and this 1.35. Now, keep in mind, this is the most passive, simplest way to approach this strategy. We didn't use any filtering methods. We didn't use any timing methods. We didn't take advantage of any of the capital appreciation of Apple. All we did was say, we're just going to sell the call right at the money and make money from that theta decay. Here's some things I want to think about. How likely is it to make 2% per month? Well, when we looked at as many occurrences as possible, we did not quite hit the 2%. But think of the amount of data here. It's very reliable for us to hit this 1.35. We have 1,200 occurrences. So over 5 years, 1,200 occurrences, we made 1.35%. Now, that comes out to 16% per year, which, if you can rely on that, that's incredible. So, I guess to answer the question, how likely is it to earn 2% per month? Based off of this exact scenario, I would say the odds are not super high, but the fact that you can basically rely on a consistent income is really the game changer here. Is this risky? Well, you're exchanging the upside in return for consistency. When you're selling options, basically what you're doing when you're renting out those rights is you're exchanging upside in return for consistency. So you might miss out on some of the huge gains, but in return, you're getting that premium upfront over and over and over. So that consistency makes up for the upside potential. Now, I don't know about you, but I personally cannot live off of upside potential, but I can live off of consistency. How much knowledge and skill do I need for this? As I showed in the backtest, we just did the same thing over and over on any given day of the week. We had 100 shares of Apple, and we sold a call on it right at the money. How likely is this to work in the future? At the end of the day, no one can predict the future. Nobody has a crystal ball. If Apple started going on a long-term downtrend, you'll probably lose money with this strategy. But as long as it stays sideways, and as long as the 2% per month outpaces any sort of decline in Apple, then you have a profitable strategy. I don't imagine Apple falling 2% per month for an extended period of time. So as long as you're collecting that 2% per month approximately by selling the option, you probably have a profitable strategy that can provide some sort of consistent income. All right, so I recommended to my friend how he can make a passive income off of a very well-known stock. And at the end of the day, if he goes ahead and sells a monthly covered call on Apple, he's very likely to make a consistent income. Obviously, it beats interest rates. Obviously, it beats dividends. You don't have to deal with tenants. So clearly, there's value to selling an at-the-money option on even a company as well-known as Apple, right? They say the markets are efficient. You can't make money consistently. Well, over 1,200 occurrences, we could have made a monthly income based off of Apple. If you have a crystal ball and you're shooting for the moon, this probably is not for you. But if you just want to make a consistent income and sleep at night, knowing that you're probably going to get paid over and over month after month, you should rest easy with a covered call on Apple. Thank you very much. Take care. See you next time.